Good, everyone. Welcome back to our next edition of Econ Talks. Gareth, we've had the latest inflation figures come out for the end of 2024, and we had a bit of stability finally. Inflation coming in at 2.2% over that December quarter compared to the same time a year before. It was the same as the 2.2% per annum result we had back in September as well. So inflation prices still going up, but going up at a more constant pace now than before when they were really rocketing up. That sort of pace of inflation definitely has been slowing back over the last year, which is encouraging. Below the surface, quite a lot of moving parts there. We saw the likes of petrol costs down 9.2% over the last year, providing a bit of that sort of lower push. But at the same time, we had rental inflation sitting at 4.2%, still, fairly high in a sense. Again, that figure up 4.2, but has been slowing down over the last couple of quarters as well. I think quite one of the challenges we really found looking through the figures is how many different trends that there were going on. We saw a bit of a re-acceleration in the likes of food price inflation, in the likes of transport, some of the transport costs, the likes of used car prices, secondhand used cars up at 4.7%, to the likes of some of your international and domestic airfares were a bit more expensive. Recreation, again, the likes of toys and games and stuff had gone up in price again. So a few areas where there was a bit more, but on the other side, some areas where that sort of inflationary push has been pulling back. So quite a lot coming through. Interesting point as well that the level of discounting for some items hit the highest we've seen in about 4 years. So definitely a bit of that disinflation, that less inflationary pressure coming through. One of or two of the figures that we often look a lot more at now when it comes to the inflation data is where it's coming from. Is it being generated here at home domestically, or is it coming from overseas and being imported? That domestic inflation pressure, what we often talk about as non-tradables, continued to sort of improve, still up, well above what it should be, but sort of slowing back. At the same time, though, that tradables inflation, that imported inflation from overseas, saw the first increase quarter on quarter that I think we've seen for about 5 quarters. So had been going down, pushed up ever so slightly, and more than was expected. I mean, with all of that, Gareth, you've got sort of headline inflation that looks pretty good, looks pretty contained. You had better domestic inflation pressures than we had expected, but worse imported inflation expectations. What do we read through all of that?
Yeah, I mean, that headline number you say at 2.2, it was slightly above market expectations, slightly above the Reserve Bank's expectations. But as you say, when you delve into the numbers, the sort of tradable prices were worse or higher than expected, non-tradable coming down. And look, the Reserve Bank expecting non-tradable inflation to continue moderating throughout this year. It does tend to be a bit sticky, a bit slower to come down. And so hopefully, by late 25, early 2026, you're getting back closer to sort of under 3%, which is the average we've seen for non-tradable inflation through most of the last decade prior to the pandemic coming along. On the tradable side, though, with prices there just ticking back up again, not alarmingly so, though I think they're up 0.3% for the quarter. So it's not a terrible result. And again, the Reserve Bank, in terms of their own forecast, they were expecting some rebound in tradable inflation and tradable prices through the course of this year anyway. So there's nothing particularly alarming at first glance around that result itself. But when you look at some of the other sort of factors that have been coming through over the last sort of 6 to 8 weeks or so, on that tradable side in particular, where we've had a substantial drop in the New Zealand dollar and sustained. We're sitting down at 56 cents rather than closer to 60 cents or 61 cents as we had been through much of last year. So that will feed through potentially into higher tradable prices going forward. We know that oil prices are also a bit more elevated than they had been as well. And generally speaking, when you look through the international economy, strength in the US in particular, and again, that's just feeding through into some concerns that inflation internationally could be a little bit stickier, a little bit higher through the course of this year than had previously been expected. And so you couple that with the fact that already tradable prices just edging back up again in the December quarter when the Reserve Bank had been expecting them to still be falling. And you look at that and go, okay, there's some concerns going forward. Now, most of the time, the Reserve Bank will tend to look through the tradable side and go, hey, we can't do much about this. It's priced on the global economy. And so, let's concentrate on the stuff we can sort of influence, can pull levers against. And that is very much the non-tradable or domestic inflation. And as we said, that's going to continue moderating this year. But I think the Reserve Bank probably does need to be a little bit more concerned about the tradable prices going forward from here for a couple of reasons. One is that we've had a high inflation over the last 2 to 3 years, and so they're still fighting, I think, really to regain their inflation fighting credibility that they had prior to the pandemic coming along. So any tick up in inflation does just sort of put that credibility, in my view, a bit at risk. The other factor as well is that some of this tradable price pressure, if we look forward through 2025, is probably going to be being driven by the exchange rate. And while the Reserve Bank can't do much about what the price of milk is on the international market or the price of meat, they can, to some degree, influence the exchange rate in terms of indirectly the interest rate levers that they pull. If our interest rates are high, it typically attracts foreign investment into New Zealand to take advantage of those returns, and the New Zealand dollar gets pushed up. Conversely, at the moment, there's concerns about interest rates remaining higher overseas and us continuing to cut our interest rates, and so that is contributing to some of the weakness in the New Zealand dollar at the moment. So the Reserve Bank, in some sense, can perhaps pull some levers around those tradable prices. And if we see mounting risks in that space, then it does start to raise questions about what they do with the official cash rate going forward.
And of course, I mean, you talk about the likes of those inflation risks. Like, we're not saying here that inflation is going to rocket away back to 7% per annum or anything like that. It's more just that there could be a little bit more of a resurgence and a bit more of a reacceleration in some of those numbers. Now, generally speaking, that's not huge cause for concern. But if you're a household who, and we know that households generally look at more recent inflation to inform their thoughts about what future inflation will be. We also know that households often overestimate inflation. You know, some of the surveys suggest that households think that inflation always runs at like 4% rather than sort of 2 to 3, which is sort of more where we're seeing it at the moment. So if that's the case, if you did see a bit more of a tick up in inflation, not a huge shift, not even above the top of the target band, but it might just sort of spur a bit more worry and concern amongst households and some businesses around that sort of inflation risk. So it's just, I guess, the last 24 hours or so that we've seen of this inflation conversation. Yep, the headline's in the right sort of spot generally. Yes, there was a miss on both sides, sort of too much of a miss down and too much of a miss high on tradables and non-tradables. But just that little bit of sort of forward looking, I think I've been a bit surprised by how much a lot of other forecasters haven't really given that possibly the airtime that the risks need. We're not saying it's going to happen. We're saying there is a risk that needs to be thought through. And I think that's important. Reserve Bank's got a decision to make mid-February with the latest or the next monetary policy statement. Still a bit of data to come out in terms of, labour market stuff. But really, this inflation figure is a pretty important one for them. They gave a very strong signal at the end of November that 50 basis point cut was their starting point. I feel like this data isn't enough to shift them, Gareth, from that. But again, with those risks coming forward, what does that mean for sort of the next couple of decisions? Because I do worry that maybe there's a lot more people than you'd otherwise want out there in the economy who are going, man, it's just going to be cut city all year, and perhaps maybe not so much.
Yeah, I think that's right. I mean, look, I think it is a discussion about 25 or 50 basis points at the next meeting, but I agree with you. 50 basis points is still very much the core scenario, and you'd have to have probably some, more really strong data coming out in the next couple of weeks to push the Reserve Bank to a 25. So let's put that one aside. Looking forward beyond that, though, we've got another 2 25-point cuts penciled in through the first half of this year, which would take the OCR down to 325. And I think the weight of evidence over the last 6 weeks or so is coming through that, if anything, the risks on that are that the Reserve Bank does not cut as far. What does inflation look like in 6 to 9 months' time, and do they need to just push back against that a little bit? Questions probably as well about what is the sort of neutral interest rate. And at times we've thought a couple of years ago, we were saying maybe it was somewhere around 4, given the change in the economy. More recently, other analysts and indeed the Reserve Bank itself have indicated it may well be in the 3 to 3.5% range, and that sort of influenced our thinking about where the bottom of the cycle might be at 325. But again, just questions with the economy starting to pick back up in terms of some of those indicators around spending. Maybe neutral is a little bit higher than that sort of 325 that we're sort of thinking of at the moment. So for me, it is a case of, we don't necessarily need to stimulate the economy a great deal more. We've had these interest rate cuts coming through, and they will continue to have an effect on household spending, on business investment, and therefore sort of on labour market outcomes and general economic growth going forward over the next 9 to 18 months. Those effects will continue to come through. We haven't seen anywhere near the full extent of them yet, and so the economy will pick up momentum. How much more do we need to stimulate it? Is it another 100 basis points? Is it 75? It's maybe, numbers around the edges there a little bit, but the risks, if anything, are that the Reserve Bank doesn't cut as much as maybe people had been previously expecting.
Which is interesting because when we've looked at what markets are thinking around the official cash rate, the entirety of last year it was cut city. It was just go down every single meeting. And it's interesting at the start of this year, markets have adjusted just a little bit, very subtly, just out at the end of that sort of expectation period, late 25 into early 26. Now sort of saying, oh well, actually there might be the Reserve Bank effectively might overdo it and need to then pitch up interest rates ever so slightly. Again, we're not saying it's going to rocket up, but it's more of that fine tuning of if it cut to 3 or to just below 3% on the OCR, there's a chance that if that did see that stronger inflation starting to come through or too much economic growth on that relative sort of stance, then the Reserve Bank might need to reverse course and sort of tighten the screws back again. And again, from the market's point of view, they're going, geez, I don't really want to go through the ups, downs every single couple of years. So there is a little bit of that calibration I think the Reserve Bank's got to look through. We're certainly a little bit more cautious than I think a lot of others around that sort of upside risk. And it is just a risk at the moment, but we're keeping quite a close eye on it. We'll continue to assess where those risks lie, what's happening with some of those inflation pressures, and what the Reserve Bank makes of all of this on one of our future editions of Econ Talks.